All right, you guys are good to go whenever you'd like.
Okay, thank you. So welcome to the session on the economics of digital currencies organized by CEBRA. I'm Jonathan Chiu from the Bank of Canada. Together with Raphael Auer, Todd Kister, and Russell Wong, we would like to thank you for joining us today. Our session has 3 excellent papers on 3 topical questions related to blockchain and decentralized finance. Each paper will have 20 minutes for presentation, 10 minutes for discussion, and 10 minutes for open Q&A. I will give you a reminder 2 minutes before the allotted time ends. Okay, without further delay, let's start the presentation of the first paper on the Lightning Network economics channels. Paolo, so the floor is yours. Are you unmuted?
Thank you, Jonathan. I'm going to start sharing. Okay, this paper is going to be in a collaboration with Huberman of Columbia Business School and Clara Shikhelman at Chaincode Labs. And what we study in this paper is not the digital currency per se, but rather a second layer on digital currency, which is the standard Bitcoin network. And what we want to understand is how the Lightning Network can be used as efficiently as possible to handle transactions off-chain. So we're talking about mostly microtransactions for which the transaction costs embedded in the blockchain would not be feasible. And so we want to understand how these costs behave and what the implications might be for the network structure that can form as a result of the implementation of the Lightning Network, which has been introduced in 2015 and which is being implemented as we speak in various different companies, and however, it is growing very fast. And right now, there are approximately $100 million in Bitcoin locked into the Lightning Network. So it's a new technology. So I'm going to start talking about the limitations of Bitcoin and scale and immediacy mainly. I will talk about a model for stationary payment flows, and I will introduce the main results in this paper, which are about the channel costs and potential structural implications, on which I'm actually not going to delve, both because of time and because this is going to be studied in a separate paper more in detail. Okay. Now, Bitcoin, quick recap, it's an anonymous decentralized payment system, so there are no trusted parties. All the payments are recorded in a public blockchain, and any user can really help processing the payment. So there's zero entry costs if we neglect the cost of hardware, which, however, is significant, but it is the same for anyone who decides to participate in the network. So each block consists in a certain number of transactions, approximately 2,000 transactions for the most recent blocks, and it is mined on average every 10 minutes. So there is this embedded limit in Bitcoin that you cannot have more than 300,000 transactions a day, which is far lower than anything that would be feasible should handle. So, for example, the Visa network can handle many more than these. I think we're talking about 2 orders of magnitude higher, for example. So the feature of the Bitcoin network is that there's a lottery between miners deciding whoever is going to mine the next block. This is part of its decentralized property. And the winning miner is typically rewarded in Bitcoin. So right now there's a block reward of 6.25 Bitcoin for each block, but also in fees. And in the long term, if the Bitcoin network is to survive, the fees are going to be the only surviving payment. So the miners right now are mining mostly to get the Bitcoin reward, but in the future they will have to mine mostly because of fees. Now, as I said, there are two issues with the Bitcoin network. One is the scale. You cannot do more than 3 or 4 transactions per second. The other one is immediacy, that to get a confirmation that the payment has been successfully added to the blockchain, you typically have about an hour. So for example, for online purchase of software or video games or any other transaction for which you need immediate confirmation, this is not a feasible solution. So the Lightning Network is a second layer which can resolve some of these issues. So the main idea of the Lightning Network is that you do not have to put all the transactions on the blockchain. So in particular, if you have Alice and Bob who are transacting often between each other, they can decide to establish some private channel, which is a ledger which is off-chain. So the transactions they are going to make over this private channel are not going to show up in the Bitcoin public ledger. And the way that they insure each other against credit risk is that they both put a certain amount of Bitcoin in as a collateral in this channel, which is essentially an escrow account, okay? And the way that Alice pays Bob is that basically she signs a message where she says that she's going to transfer some money to Bob, and this is added to the escrow account, essentially. This is how the Lightning Network works at the cryptographic level. This is ensured to be secure. So when the escrow account, escrow initial amount that Alice had set up is depleted, then basically all the escrow is owned by Bob, and then Bob can redeem it through an on-chain transaction on the Bitcoin network. And then if they want to continue to transact, they can put up some more escrow, each of them, and they can continue to transact this way. So what is important is that in a Lightning channel, payments can go in both directions. And as of last month, I think the first implementation of a bidirectional channel has been completed. So right now you can have bidirectional channel, and up until 6 months ago, you could only have unidirectional channels where a single party would put up a certain amount of escrow, and then they both could transact, but initially there was only one could transact. But now you can start a new channel with both parties putting in some Bitcoin. So what is cool about the Lightning Network is that this does not work only for 2 people, but it can handle links, okay? So links means that if Alice is connected to Bob and Bob is connected to Charlie, so Alice and Charlie do not necessarily have to connect each other with a new Lightning channel. They can simply use the existing channel between Alice and Bob and Charlie, so that Alice can pay Charlie through Bob. Of course, if Bob agrees to do that, and if he decides to agree, he could also decide to charge a fee for the service, okay? And this is another story that we're not talking about. We're not going to talk about here. Now, what is the question? Okay, so main question is, who should open channels? Who shouldn't? And more importantly, how much should you deposit when you open a channel? Should you deposit a lot, a little? Of course, this depends on a number of variables, okay? And related question is, what is the minimal cost of the channel for all parties involved? And if one can figure this out properly, then one can use the cost theorem, as it is called in economics, to have payments between parties so that they can essentially compensate each other to do the socially optimal thing. Okay, so this is more or less the research agenda. In this talk, I'm going to answer only the first of the question, basically. So how much should each party deposit and which channel should be opened? So we're going to consider a very simple model. There are 2 users, 1 and 2, or Alice and Bob, if you prefer. User 1 is paying user 2 with a certain frequency represented, for example, through these Poisson arrival times with array lambda 1. And user 2 is paying user 1 at some other independent Poisson arrival array, which we call lambda 2. And what we're going to do is to let user 1 commit a certain amount, L1, user 2 commits a certain other amount, L2, and then they are going to continue to transact on the channel until one of the two parties depletes the entire initial deposit, at which point there is an on-chain transaction to record the transfer to the other party, and then a new channel will start again. But whenever a new channel is started, there has to be a cost related to the closing and opening of the channel. Okay, so for convenience, we're going to call the cost of opening a channel or closing a channel B/2, so that opening and closing is going to cost B exactly. Okay. So what is the main idea? The main idea is that there is a trade-off between two types of costs. One type of cost is the cost of transacting on-chain, which is B, every time you do it, to open and close the channel. The other cost is the cost of committing capital. So that's basically the cost implied by the interest rate, which you could have earned on the capital that you have deposited on the channel and you have not used for other purposes, such as investment. And here we're going to assume that the interest rate is constant. We call it R. So if you keep L1 plus L2 locked into a Lightning Network channel for a DT length of time, the cost is going to be R times lambda1 times plus lambda2 times DT. Okay, that's the main trade-off that we're going to consider. The case of a unidirectional channel is just a special case which is achieved when you set either of lambda1 or lambda2 equal to 0. So there is some literature here, but I'm going to skip most of it. So the more important topics here to notice are the seminal papers of Baumann and Tobin on one hand and Miller and Oordt on the other, who studied demand for cash, which is a related problem, not exactly the same. But they also have this trade-off between, going to the bank to retrieve cash, and that implies a cost, and also having cash which is in your pocket rather than in bank, so that it does not earn interest. So there's a similar trade-off, but the problem is not the same, because in this case of Lightning Network, you can always go on chain instead, while in the demand for cash problem, there is not this option. Okay, so the first question is, when should you at all open a channel? When with somebody else, okay? And the main idea here is that if you do not transact often enough, you should not open a channel. So here, the main idea is that, first of all, you calculate what is the cost of not opening your channel. So if you put all of your transactions on chain, what you're going to pay for your stream of payments from now and forever, it's going to be lambda B divided by 2R, where R is the interest rate, lambda is the frequency with which you are paying, and B is the cost of opening of a single, B/2 is the cost of a single Bitcoin public blockchain transaction. Okay, so the idea is that whenever the cost of doing this is lower than the cost of a Lightning channel, then you should not use the Lightning channel at all. Okay, so the first result that we have here is the cost of unidirectional channel given the initial deposits L1 and L2. And as you see here, also from the formula of the unidirectional channel, for example, you see immediately that there is one term, L2, which is just the cost of the deposit that you are committing. Because this is a stationary model and the payments go on forever, the amount that you are locking into the channel is basically an amount that is lost. Therefore, L2, the amount that you're committing to the channel, will never be available for any other purpose. So effectively, you are locking it up forever, and that shows up in the cost. And the second term represents the cost of all the periodic transactions that you will have to do if your chosen capital is lambda2. So you see that it shows up here in the exponent, and if you want to take L2 to be very large, this amount, this cost of transacting will go down to be very close to zero, but then you're going to have a very high cost of capital, and vice versa. And for the bidirectional channel, the situation is significantly more complicated, but it can be done, okay? And you again obtain formula where you have initially the total amount of capital that is committed to the channel, and then another term which summarizes the cost of transacting in both directions in this case. So this is a bidirectional channel with initial commitments, the ones that have been implemented last month, but at a theoretical level, one could already envisage how they would look like. So we already calculated this before it was implemented, actually. Okay. Now, what you learn from these formulas is that in order for you to establish a channel, you need to have a transaction rate which is sufficiently high. So if lambda is below 2r divided by b, you should not even bother. Okay? You should not even open the Lightning Network. You should just transact whenever it happens to be necessary directly on chain. Okay, and you don't worry about the Lightning Network. Now, we can also have a similar statement for the bidirectional symmetric channel. In this case, you have a similar bound. So the main message of these two results is that essentially what you really should consider is R divided by B. So the interest rate divided by the cost of an on-chain transaction. If the payment frequency is large enough relative to that, then it makes sense to open Lightning Network channel. Otherwise, it doesn't make any sense. Okay. Now, if you want to get some explicit formulas which are more informative, then you can do that, but you need to look at some asymptotics which are available in the case of R, the interest rate close enough to zero, which seems a natural asymptotic to consider because nowadays interest rates are not particularly high and they haven't been high for a while for that matter. So what we learn from here, and this goes back to the comparison with the classical work of Baumol and Tobin on one hand and Miller and Oordt on the other, is that a unidirectional channel, so when one party only is paying and the other one is only receiving, is of the order of the square root of b lambda over r. So this is what turns out to matter in these calculations. The cost of a transaction, b, times the frequency of transacting, which is lambda, divided by the interest rate. So this is essentially a sufficient statistic for the first order term of the cost of this channel. And we see that it is of the order 1/2, which is the same order obtained by Baumol and Tobin in their classical work. And also the committed capital is of the order of the square root of the transaction frequency. Okay, so these are for unidirectional channel. For a bidirectional symmetric channel, instead, what we obtain is a different order. We obtain the order 1/3, which is the same order identified by Miller and Oordt in their bidirectional payment model. And this, however, is correct only for a bidirectional but symmetric, okay? So a bidirectional symmetric is more efficient, meaning that the amount of capital committed is only, and also the total cost of the channel is only proportional to the payment frequency to the power of 1/3. Because essentially payments are going both directions, they cancel out a lot. And this netting effect essentially allows the two parties to save a lot on liquidation when either of them is going to run out of money. Okay.
We have about 2 minutes left.
Yeah, so in these 2 minutes, I'm going to tell you about what happens in the general case. In the general case, it's more complicated and it depends on how close the two payment rates are. So if they are very close, meaning the difference between lambda 1 and lambda 2 is of the order of the interest rate to the power of 1/3. Essentially, the channel behaves like a unidirectional channel, with as a bidirectional symmetric channel. So the rate is still 1/3, but the constant in front of it changes now. And also the amount of capital committed is at the first order of order 1/3, but there's also an additional term of order 2/3. However, if the two payment rates are significantly different from each other, then it's interesting because you get that at the first order, the channel behaves like unidirectional. So there's no netting going on, essentially, because the two rates are very different from each other. And however, the amount of capital that the typical payee should put up is not going to be close to zero or even to constant, but it should grow like the logarithm of the difference between the payment rates of the two parties involved. So this is significantly more complicated. At the first order, it looks like Baumol-Tobin, but to implement it, one cannot use some heuristic argument. One needs to put up some optimal capital here, which is of proportional to the log of the payment rate. And here you can calculate also the traffic reduction. The main message here is that for unidirectional channel, the traffic reduction is proportional to the size of the channel. But for a bidirectional symmetric channel, it is proportional to the square of the capital committed, so of the size of the channel. So there's much more traffic reduction for bidirectional symmetric channels. And if you want to look at what is the optimal setup when you have two parties paying each other, you have a picture like this. So in the red situation, when both payment rates are sufficiently large, you are going for a single bidirectional channel. In the purple situation, when the two payment rates are both small enough, you do just everything on chain, no lightning networks at all. If one of them is high and the other one is low, or vice versa, what turns out to be optimal is just to pay on chain on the more rare direction and on a unidirectional channel in the reverse direction. So in particular, it is never optimal, it turns out, to establish two unidirectional channels in opposite direction. And this concludes essentially my presentation. So I thank you for your attention, and I leave the floor to the discussant.
Thank you. Our discussant is Maarten from the Bank of Canada.
Thank you, Jonathan. Let me try to spotlight myself. I think first, Paolo needs to stop sharing. Let me see. Okay. So thank you, Jonathan, for the invitation to discuss this paper, Lightning Network Economics, the Channels, by Paolo and his co-authors, Currencies and Clara. My name is Maarten van Oordt. I work at the Bank of Canada as a research advisor in digital currencies. And just kind of to start a little bit with a quick helicopter view for the first few minutes of my discussion, like one thing that's obviously kind of preventing people from using cryptocurrencies for day-to-day payments is the cost of making payments with Bitcoin. So kind of if you look like over the past months for Bitcoin, Ethereum, the price to make a transaction has been hovering between $2 and $5 US, median price. So if you think about that, like you're not going to pay your coffee with Bitcoin as a consequence of that. Now, one of the reasons why that is an issue is that, or why that issue arises, that there's limited space on the blockchain, and then there have been several solutions in the space to actually kind of try to resolve that issue. So one thing has been to rob Bitcoins, so basically kind of set them aside, lock them based on some way that you kind of try to provide trust that these Bitcoins will stay there. And it's now possible, for example, to trade Bitcoins, rob Bitcoins on the Ethereum network, on the Binance Smart Chain, and also on this new chain called Risk. But still kind of in the end, if you think about it, like you're still kind of transacting Bitcoins on the blockchain. And then there's this radically different approach, which is called the Lightning Network, is basically going to say, okay, we're going to provide a way that allows you to make trustless transactions in an environment where you actually don't have to put all the transactions on the blockchain. Now, the promises of the Lightning Network are huge for cryptos: instant payments, scalability, and low cost. So kind of if you think about it, like these are potential things that you really want to see for crypto payments if you wanted to see being adopted for more standard payments. And a very important building block of that Lightning Network, it's basically linking these payment channels, trustless payment channels to each other. And basically how they work is kind of Alice can put a Bitcoin, she can lock a Bitcoin into a payment channel that costs a Bitcoin transaction, an on-chain transaction. And after that, she has this payment channel with Bob. Of course, at the start, like she put a Bitcoin in, so she kind of owns that Bitcoin in that channel. But then by kind of agreeing with Bob that he now owns a larger share, she can make a payment to Bob. And by Bob and Alice agreeing that now Alice owns a larger share, Bob can make a transaction to Alice. And basically, if either of the two parties want to have their Bitcoins actually back on the chain, they just have to kind of submit a closing transaction. Well, then of course, like the issue is like, how do you actually make sure that everybody claims just the share that they own? And that is where what makes these payment channels trustless. So there's kind of a smart incentive mechanism behind it that will penalize you if you try to claim more than you should actually own. So people do not tend to try to claim more than they would like than they own in the channels. And then this paper, kind of taking this really important building block in the Lightning Network, this paper is kind of saying, okay, suppose you have an Alice and a Bob and they want to make payments to each other, then how should Alice and Bob make payments? Should they make them via a channel, or should they make them on a chain? And then basically how they kind of approach the problem is kind of a a classical approach in monetary economics. So they take a Baumol-Tobin type of an inventory model, which you can think about like, which was modeled, for example, for the demand for cash. So you can think about it like, well, putting money in a channel and taking it out of a channel, that's costly. That costs an on-chain transaction. So that instead of walking to the ATM, you're now submitting this Bitcoin transaction. There's a cost of capital for funds locked up in a channel. So kind of you cannot use these funds for another purposes at the same time. So they are kind of locked up. There's an exogenous pattern of payments. Kind of these are all ingredients of this Baumol-Tobin environment. And then they add something nice to it, which kind of which was done before in a Baumol-Tobin context by Miller and Oordt by actually making payments uncertain. So people don't, of course, anticipate precisely how many payments they need to make. And then there's actually an important modeling difference, I would say, between Baumol and Tobin and Miller and Oordt and what Paolo and his co-authors are doing, because actually in Baumol-Tobin, if you don't have cash, you cannot make transactions. But here, in principle, you're kind of always kind of comparing, like, should I open a channel? Should I carry cash? Or should I actually make these transactions on the chain? And just kind of to highlight why this is super important. So typical kind of like how the paper is set up, it's kind of just talking about Alice and Bob who need to make transactions. But if you think about it, like Alice could be really on the edge of the Lightning Network, and Bob could be like here the spider in the middle that connects Alice to the entire Lightning Network. So you can think about more generally about these payment flows that are going in between Alice and Bob. These are kind of all the payments that Alice wants to make to everybody on the Lightning Network. And in some sense, you can think about like all the payments that go from Bob to Alice as all the payments that Alice would like to receive from people on the network. So kind of, I think kind of trying to get this right is a really important thing. So I have a few comments about the paper, besides just saying that I think it's an important part to kind of study Lightning Network. So the first thing that, one thing that I didn't particularly like about the set of solutions that were studied in the paper is kind of there's this ex-ante choice, whether people should pay either exclusively via a channel or exclusively on chain. Paolo touched upon it at the end of his presentation. And then, so there are basically three types of solutions. Either everybody pays everything via channel, or everybody pays everything on chain, or the third option, one person pays exclusively via channel and the other person pays exclusively on the chain. Now, suppose that Bob and Alice often want to pay. Of course, you end up with using a channel. That's the cheapest option. If Alice and Bob don't want to transact very often, then you end up with all transactions on the chain because the liquidity cost of locking up the funds is too high. But then, like, suppose that Alice wants to pay Bob very often and Bob hardly ever wants to pay Alice. Basically, the solution that the authors end up with in the paper is that, well, Alice will pay Bob via a channel always, and Bob will always pay Alice exclusively on chain. And if you kind of think about it, like, well, suppose Alice just set up that channel, then Alice owns basically all the Bitcoins in that channel, and Bob owns 0. So Bob cannot make a payment to Alice using that channel. But then suppose that Bob would wait a little bit until he got some payments from Alice. In principle, if Bob would be in this situation, actually he could use that channel to make a payment to Alice. It would be cheaper for Bob because he would avoid the transaction fee. And then on top of that, Alice would also be happy with that because they could use because Alice could use the channel for more payments to Bob. So it seems kind of that the optimal strategy here would be Bob in principle paying on chain, unless he actually can use the channel if there are funds on his side. So I think that's kind of one direction to kind of improve the solutions.
Maarten, we have 2 more minutes.
Think you. So the second comment is about just the interpretation of the discount rate, and it's kind of just to kind of think more broadly about a parameter in a model. So currently, the authors think about like the cost of locking funds up in a channel purely as a discount rate, but I would kind of suggest to kind of interpret it more broadly and also think about it. This is also capturing some of the additional risk of holding Bitcoin in a payment channel, because actually funds held in a Bitcoin channel, it can be lost in a variety of new ways that you could not use Bitcoin if you would not lock them up in a payment channel. So there's kind of there are several ways that basically your funds come at risk from technological errors as well as malicious attacks. So you can think about this as kind of, you can think by R, not just thinking about the liquidity cost, but on top of that as capturing some of the additional risk. And then my third comment is when to pay the bill. So kind of this type of models, and it's kind of more general comment, this type of models, they take the frequency and the size of payments as exogenous. But if you think about it, if Alice and Bob are really transacting very, very often, would it really be optimal for them to lock up the funds? And is it really necessary for them to pay each other that often? Could they not kind of settle the bill a little bit less often? And even in a world where you have no legal recourse, it may not be necessary to always lock up funds in a channel. You may have both counterparties may have incentives to behave well when they want to continue the relationship. So one question, kind of more an economic question, is when is it necessary to lock up funds, and how often should counterparties pay each other? Now, this is not really for this paper, and it's also a little bit just an advertisement for a paper that I'm working on, honestly. So kind of this kind of a paper that Charlie Kahn and I try to address, and a question that we try to address in this new paper on the demand for programmable payments. And then I simply want to conclude with saying like this, the authors have been extremely forward-looking when they were writing this paper. Like I remember the first time that they were presenting this work, at that time, the Lightning technology was not fully developed in a way that they described it in the paper. So you could only have single funded Lightning channels, in the sense that only one of the two sides could actually put funds in the Lightning channel when they were kind of opening the payment channel. But actually just 2 months ago, like the first dual funded Lightning channel was opened. So I want to congratulate the authors on writing such a timely paper and having kind of these solutions already on hand just before the technology was actually developed. And then the final thing I want to say, I think the model seems to capture many of the important aspects of deciding the optimal channel size. And given this new development kind of in the cryptocurrency space, I think it's a very relevant paper. Thank you.
Thank you, Maarten, for the very informative discussion. Paolo, do you want to give some quick response before we go to the Q&A session?
Sure. First of all, thank you, Maarten, for the discussion. It was very insightful. So about question 1, so I agree with you that intuitively one would expect the less frequent payer to use the existing channel for the reverse payment. But we have considered that possibility, and it turns out that doesn't seem to be optimal. Okay, so we only have numerical results there. We do not have theorems, but we have considered 5 possibilities for each of the points in that square, essentially. And the 5 possibilities are that either both go on chain, or that one goes on chain, the other one goes on a unidirectional channel, or that they both go on unidirectional channels, okay, which would be also another possibility, or that they go on a bidirectional channel. And for each of the points, we have looked at the configuration, which turns out, and the picture looks like that. So the fact that one of them starts paying, and he's only the one that puts in the escrow, and the other one only pays when that becomes optimal. This is actually not a stationary solution, because if they wanted to start it that way, so this is not a plan, because if it turns out with the some low probability that the first payment has to be done by the guy who has put in 0, then this is not going to work out, and he will have to do that payment on chain. So the one thing that we do not allow for is that, depending on the conditions, you either go on chain or on the existing network. So along those lines, I agree that there could be an improvement, but we don't know how to do it exactly right now. So I do not want to take any more time, but I think that the other 2 comments were very relevant. So in particular, the interpretation of the discount rate, I think is a bit tricky, because right now there isn't any a clearly observable borrowing rate on Bitcoin. So if that should change, it would probably be the correct interpretation.
Okay, thank you. I think Ganesh has a question about empirical question, and also question about comparison to other second layer solution. Ganesh, do you want to ask a question yourself?
Yeah, sure. I guess I was just curious on the empirical sort of observations of transaction rates on Lightning Network compared to outside the Lightning Network, and also if the like ETH doing something similar. Although I personally am not an expert on this, I'm just kind of curious as a kind of crypto enthusiast.
Okay, so I have to say that I'm not an expert myself on the empirical side. We are working with a colleague on trying to pass the blockchain for some of these issues, but this is work in progress. What I can tell you is that it is not obvious from the analysis of the blockchain to identify a transaction which represents some reset of a channel or some closing or opening from the Lightning network. Part of that is that the Lightning Network is still new technology, so there isn't too much usage compared to the overall transactions on the blockchain. But I'm sure that some company like Chain Analysis or something like this is going to develop something like this. From that, we might learn more. Right now, I do not have the answer. Now, regarding Ethereum, I am still learning about Ethereum. So right now, I'm not aware of any second layers solutions on top of that. But I do know that on the Bitcoin Lightning Network, there are already some applications which allow for micropayments between users of, let's say, consumers of videos and video producers. And I think that this is a great technology in principle, because right now, when you're watching a video, there are a lot of parties involved. There's the consumer, there's the video producer, there is the ad, the advertising company, and then there's the platform that makes a lot of money out of being between these users. But if you have this implementation of micropayments on a Lightning Network or even on Ethereum, if that comes over, then basically the producer of the video and the consumer of the video can actually interact with each other, cutting off both ads and platforms that charge like 30%. So Perhaps this is not related to your question, but perhaps is relevant.
Thank you.
Thank you. I think it's a perfect timing. Indeed, after the session, if people would like to stay for a bit longer, we can continue the discussion. For now, I think it's time to move to the second paper on decentralized exchanges by Alfred Lehar from University of Calgary.
Okay, thank you very much for having me at the conference. And so this is joint work with Christine Parlour from UC Berkeley. And we want to talk about decentralized exchanges. So what is the idea? In most modern exchanges, they are operated as some kind of electronic limit order book, and people generally think that this is the most efficient way to provide liquidity. But the key assumption underlying this idea is that market makers are perfectly competitive and make zero profit. We want to think of a world where there is some investment possible in say, high frequency trading, where people invest in co-location, and these liquidity providers, not liquidity traders, but the liquidity providers try to carve out some kind of competitive niche and extract some rents out of this investment. So there's often a complaint by institutional investors when they want to trade large quantities on exchanges that they see a lot of posted liquidity. But when they actually want to trade larger quantity, then this liquidity quickly evaporates and is gone, and they find that they have to effectively trade at a much worse price. So we want to examine a new form of liquidity provision, which is these liquidity pools that we see in decentralized finance. So what are our main findings? We think we can show that these liquidity pools can actually dominate limit order markets when there is a lot of uninformed trading, when prices do not move that much, and when the incentives to invest in this high frequency trading technology are strong. We take our predictions from our model to the data, and we find that these liquidity pools seem to track the limit order markets very well, that they have a lower price impact, and they also have a lower variation in price impact, which might be important for these institutional traders that want to trade large quantities. So what is the data that we look at? We look at Uniswap, which is the largest the first and biggest decentralized swap facility. So this is part of DeFi, which runs on the Ethereum blockchain. So this is not just some kids playing around with this. The daily trading volume is over $3 billion, and the posted liquidity there is $7.5 billion in our sample period. But Uniswap is just one of these markets. There's a lot of other ones. They're called Sushi Swap, Pancake Swap. There's a little bit of a food theme going on here, but there's many others, 1inch, and that are pretty much doing very similar things and providing liquidity in the same way. So Uniswap is not one monolithic entity. It comprises of tens of thousands of individual liquidity pools, and anybody can become a liquidity provider and on these markets. So I'm also a Uniswap liquidity provider. Trading is very simple. If you want to trade token A against token P, you send the token to the smart contract, and then the smart contract sends the token B back to you. And it's deterministic. And I want to show you in a second how the pricing works if you want to trade tokens. But before we go there, let me talk a little bit about how we think about the limit order market. So we have a model in the paper that I don't want to go through the math, but you're welcome to read up on that in more detail in the paper. But we have a model where we have competitive liquidity providers similar to a standard microstructure model. So they can either trade with a liquidity trader or with an informed trader. And they gain from selling to the liquidity trader, but they lose from trading with the informed trader. And so on average, these liquidity providers break even. So that's our standard microstructure model that we use in the literature. And these liquidity providers in our model can invest in this technology that gives them some chance to carve out the competitive niche where they have some market power. So you can think about that as high frequency trading, learning if a large institutional traders placing an order, learning some information faster than others, things like this. So this monopolist liquidity provider then charges, of course, a higher spread and earns some money. The technology is wasteful and costly, so this is from a social aspect not desirable to have that. So we compare that to a liquidity provision in a liquidity pool in the style of Uniswap. So suppose there's some pool with two tokens, we call them E for ETH and T for token, and the exchange rate in that pool is always the ratio of Ether to token. So let me show you a little bit how this works. So this is determined by bonding curve. So any trade amount that you trade in ETH versus any trade amount that you trade in token, so you swap Ether against token, it has to be in such a way that the product of the two, these two numbers is constant. So how does that look graphically? So you have this kind of bonding curve here that is given by this constant, and then you suppose there is, we start out at this red dot point here, so where we have some amount of ETH in the pool and some amount of token in the pool. What happens then if somebody wants to send some token to the pool? We see that the balance of token goes up, so somebody wants to sell their tokens. The balance of tokens in the pool now increases, and how many ETH does the trader get in return? That's determined here along the y-axis. We see that the new pool point has to be again on this bonding curve, and the difference between E0 and E1 is the amount of ETH that the trader gets for selling this amount of token. That's the difference between T0 and T1. So it's a very simple deterministic system, then everybody can see what's the balance of the pool, so you can pretty much figure out ex ante before you trade what price you're going to get. So how do we want to think about this in terms of again, a simple microstructure perspective? So these liquidity providers always earn some kind of fee per trade, and that's what they get compensated for, providing this liquidity. And now these liquidity providers could face two types of traders. So we could face a liquidity trader where there is not really a change in the true price. So what happens? The liquidity trader comes and pushes the price from E0 T0 to E1 T1. But that's not the true price. So the true price is stayed the same. So an arbitrageur will come and push the price right back to where we started from. So graphically, you just move from the red dot to the blue point, and then from the blue point again to the red point along this curve. So for the liquidity providers, nothing has happened, no harm has been done, because you're exactly back at the same point where you started from. But actually something good has happened. You have earned 2 times the fee from these 2 trades. So this is actually a good event for the liquidity providers. Now, what happens if there is a change in the true price? So if the true price really moves from E0 T0 to E1 T1. So then the liquidity pool is, of course, totally unaware that this change has happened. It's just a computer program, right? They cannot see what's happening in the outside world. So the liquidity pool still quotes the price E0 T0. So the price of the liquidity pool is stale. So an arbitrageur will come in and take advantage of this mispricing and say, I can buy a token at a stale price, or I can sell a token at a stale price. So that's an opportunity to make some money. And so the pool gets picked off and the liquidity providers lose out here in this case. So we look at some data on this. So we look at all the Uniswap. We run it with 2 liquidity pools, and these are 36,000 individual pools. They consist about 4,000 V1 pools and 30,000 V2 pools. So we have 47 million transactions. There is about 1 million liquidity injections into these pools and about 600,000 withdrawals and 45 million trades of tokens. Just to give you an idea of what these numbers look like for the large pools. So in the upper panel, we have the large pools for version 2 of Uniswap. And so these are big trading volumes. So the largest pool is wrapped ETH against Tether, a US dollar stablecoin, and they trade every day about 7,500 transactions, $72 million a day is being traded. And for some of these pools, these actual volume numbers here are pretty big. The other thing, sorry, we see from this graph is that a lot of the tokens are traded against wrapped ETH. So wrapped ETH is the token representation of Ether, the native coin of the Ethereum blockchain. And this seems to be kind of the central part of this, the Maria almost of this trading network. We also see that US dollar stable coins take a prominent position here. So this is Tether, USDC, DAI, and FEI are all US dollar stable coins. So this is a graphical representation of how this trading network looks like. So we have here the largest 50 tokens, and whenever there is a liquidity pool between 2 tokens, we see a line connecting these 2 tokens, and the thickness of the line is proportional to the trading volume. So we see here that wrapped ETH is a central part of this network, so that it has the most lines connecting to all these tokens. But there's also the US dollar stable coins that have a lot of liquidity pools that they are active with other tokens. So we have USDT trading directly against a bunch of other tokens, USDC and DAI as well. Those are the other thing that's interesting is that this seems to be some kind of a core periphery network structure, similar to what we see in many other existing financial networks. So just to give you an idea about the trading volume, so the daily trading volume fluctuates a lot. A lot of trading happens on version 2. Version 1 is here in the blue part that kind of was not so big, but so we see this huge exponential growth. A lot of tokens trade directly against wrapped ETH, which is the orange part, and the red part shows you tokens that trade against other tokens. And so this is not so much the common thing that we see. So what drives the size of this liquidity pool? So we build a little theory model, and we think about what determines the optimal size of these liquidity pools. And the way we would like to think about this is that the fee revenue that the traders receive, that liquidity providers receive from the people who trade with the pool has to be equal to the loss from quoting stale prices. So that's kind of the equilibrium condition that determines the pool size. And then we can think a little bit about comparative statics, what drives these fee revenues. So the fee revenues get shared amongst all the liquidity providers, so we can think about what happens if there is losses from quoting these stale prices. And so if these losses increase, what happens is that the pool optimally shrinks. And so then 2 things happen when the pool shrinks. The price impact gets higher, but also those losses, those fees that you get in compensation for these losses that these liquidity providers have, the fee revenue gets shared amongst fewer liquidity providers, so the fee revenue per person kind of goes up. So we have some predictions about the optimal fee revenue here. So as I said before in the introduction, the fee revenue, the optimal pool size decreases in volatility, when there's a lot of price movements in the token, then there's more chances that the pool gets picked off, and so the pool is smaller. We see this confirmed in the regression. And then we look at uninformed trading, and our prediction from our model is that the pool size should increase in uninformed trading. So we use 3 measures for that. So one is the volume in US dollars. So if we assume that the information flow and the amount of innovation is exogenously given on a certain day, so there's only so much that you can trade on based on true price changes. So anything else that's traded beyond that is noise trading. And so we see that when there's more volume, then there is a larger pool size. Also, when the number of trades is higher, and again, we would say that the amount of informed trades, the amount of innovations that arise, and therefore the amount of trades that are based on price changes or information is constant. So if there's more extra trading beyond that, it's uninformed trading. So we see that the number of trades, higher number of trades, also makes a larger pool size. And the last thing we think at is these reversals. So if you think about these liquidity providers, when there is a liquidity trade, I told you the story that the liquidity trader comes, pushes the price away, and then an arbitrageur comes and pushes the price right back. So we look for these patterns in the data. When there is a trade that moves the price, and after that, immediately there's a trade that pushes the price back. We call that reversals, and that's our measure for liquidity traders. And we also find that if there's more of these patterns in the data, more liquidity traders, then the pool size is also larger. So one of the benefits that these markets have is that there is no short-term evaporation of liquidity. So we see overall that there is very few liquidity withdrawals. And if we look at actually think about high-frequency trading, so we only have 18 observations in the data where somebody deposits and withdraws liquidity within 5 blocks in an amount greater than $1,000. So there's not much happening in that sense that people strategically come in, provide liquidity, and immediately withdraw liquidity. We don't see that happening. So there's only 18 out of 45 million observations where we can observe that. Another fact about stability of liquidity provision. So here we have a big drop in the Ethereum price and around on May 19th. And so just to give you an order of magnitude, this was twice as high of a drop as the October 87 crash in the stock market. So Ethereum dropped here from $3,400 to about $2,000. And so we see the Ethereum price on a minute-by-minute basis here in the orange area. And the blue line that we see here is the liquidity flow out of Ethereum US dollar stable coin pools. So what we see here is that when the price really hit the low point, there was actually not much liquidity withdrawn out of these pools. So we only see that 2%, so if you look at the right axis, about 2% of the liquidity was withdrawn from these liquidity pools. So they seem provided a lot of liquidity in these periods of the sharp drop. Afterwards, after the Ethereum price had somewhat recovered, there was a liquidity withdrawal here, but still it was fairly low at about 17% of the liquidity was withdrawn, which is still not a lot. So if you think about the stock market, what would happen if there is a 40% price drop? Probably then a lot of, I don't know if the liquidity provision would still be that stable in a regular stock market setting. So we also want to compare that directly, the liquidity pool, to a limit order market, and we collect some data from Binance, which is a limit order market, and I just want to show you a few pictures on that.
We have 2 minutes left.
Okay, thank you. So here we look at the pricing error, which is the blue line, and that goes with the right axis. So the pricing error between Binance and Uniswap, for this is the example of the USDC ETH pool, is in general pretty small, except for this early part here where we see substantial pricing errors. But that was the time when the pool was pretty small. So we plot here in the orange area, shows you the size of the USDC ETH liquidity pool on Uniswap, and this goes with the left axis, and it's on the log scale. So we see that once the liquidity pool hits about 700 ETH, which is actually not that much, we see that the pricing error is almost negligible between those two markets. In fact, we were kind of surprised that these prices track so well. So this is a high frequency chart for one particular random day, and that shows the price on Binance, which is the blue line, and on Uniswap, which is the orange line. The next graph I want to show you is that the price impact. So we compute price impact on Binance in the blue line, and on Uniswap in the orange and the green line. So on Binance, we see that first of all, price impact is higher than on Uniswap, and also the price impact varies around a lot. So there is this time where there's a lot of liquidity provided and price impact is low, and we have these spikes where liquidity evaporates and price impact is really high. And so that is an uncertainty that you face as a trader on these limit order markets. That is not great if you don't know how stable the liquidity provision is. On Uniswap, down here, so we have an empirical measure, which is the orange line, but we can also derive the theoretical measure because we know the curve, and you can compute a theoretical measure of price impact as the slope of the curve, and we see that both are extremely low, and they're also very stable. There's no fluctuation. So it's a very predictable market to trade in as a trader, and you know that you're going to get your liquidity will be provided in these markets. And probably the last thing I want to show, since my time is up, is that these markets are successful at competing with limit order markets, and sometimes seem to have the upper hand. So here we have the volume traded on Binance in blue and on Uniswap in orange. And the Uniswap pool was started here, so it started out kind of small, but then as it grew, it finally overtakes Binance in terms of trading volume. And the second interesting finding that we see here is the trading volume in these two markets seems to be fairly correlated, which was also surprising to us, that we see this high correlation in trading volume. So I think my time is up. Thank you very much. I just want to leave that there. So we want to come up with this new model of liquidity provision, and we show that in some cases these liquidity pools, as they are developed in these decentralized financial markets, actually can dominate limit order markets and provide some real benefits for users. Okay, thank you very much.
Now our discussant is Agostino Capponi. We are not seeing you. Okay.
Yeah, so you should be able to see the screen now, right?
Yep. Okay.
Okay, good. Okay, so thanks a lot, Jonathan, for putting together the session and for asking me to discuss this paper by Alfred and Christine. So I will provide my take and my view on this paper. I think Alfred has highlighted some important aspects of the paper. I will emphasize some aspects more than others, but this just reflects my own takeaway of the paper. So my understanding, basically, what the main objective of this paper is to propose a framework to compare liquidity provision in centralized limit order book and automated market maker. So one is the centralized platform, the other is the decentralized platform based on DeFi exchanges. And then, after developing a theoretical framework, they explore their implication, the testable implication of their model empirically. And two implications that they look at is that the relation between the size of the liquidity pool and the characteristics of the pool in terms of like trading volume, exchange rate volatility, and so on. And then they want to look at the deviation of prices between the centralized limit order book and the AMM. For example, what would be the different price that the token, like an Ethereum token, could have in a centralized limit order book versus when you trade it in AMM, which stands for automated market makers. And likely, Alfred has already given a good description of how the automated market making works in terms of like determining the exchange rate based on the demand and supply of tokens available in the pool. So I will not repeat that part. I will just start summarizing the setting and the results, and then making a few comments both on theory and on the empiric part. So then the model, I think, is basically, as Alfred discussed, yes, two liquidity providers who are competing. There is a noise trader, and then there is an informed trader who is able to observe the fundamental price change. So pretty much similar to a Kyle's model, meaning with some variations. Because of course it's adapted to study the question of decentralized exchanges. And for the liquidity provision at the set limit book, what happens is that the noise trader is exchanging Q amounts of the asset, but this amount Q is exogenous specified. And the only strategic variable here are like the liquidity providers and the informed trader decision, whereas the noise trader is an exogenous player. And this trading generates revenue for the liquidity providers because like the liquidity provider is charging a bit of spread, so it's earning like this transaction cost. And there is adverse selection because we have an information-driven model, so informed trader can adversely select the liquidity providers. And as usual, how do you mitigate adverse selection? You can charge a bit of spread. And then the winner takes the order. So there are two liquidity providers. My understanding is that these are like Bertrand competitors, so they basically compete on prices, they undercut the price, and in the end, by the standard theorem that basically when you have perfect competition, there should be zero expected payoffs for the players. That's what happens. So basically, you have zero expected payoff. The other, the new part that they are adding also is the fact that they are investing on monitoring technology, which I understand. Practically being the fact that these liquidity providers are basically spending effort and time in deciding in which exchange to trade, like which platform to use. So for what are the main results or some results that they have is that the noise trader, their paper is trading Q amount of assets regardless of the trading cost. So no matter how large is the trading cost, the noise trader is exogenous, it always trades the same amount. And then an arbitrager is conducting a reverse trade in order to bring the spot rate back to the fundamental. Because when we trade, like we know that an amount of tokens that are being the supply of tokens in the automatic market maker changes, and as a result, there is a different exchange rate because this is determined by the ratio of available token A versus token B. So when an arbitrager conducts a reverse trade, he tries to bring the exchange rate back to what it was before the noise trader traded. And of course, when they trade, they generate fee revenue. Adverse selection leads to loss, but because of different functioning mechanisms of the AMM, this loss cannot be mitigated, for example, by charging bid-ask spreads. And also the revenue coming from the fees and the revenue in general, they are shared throughout all the liquidity providers. So there is no incentive for competition, in contrast to the centralized limit order book. And there is also no need for the monitoring technology, which is, I agree that there is no incentive for competition. I don't agree completely that there is no incentive for monitoring technology because of yield farming. So meaning there is also some effort in monitoring by liquidity providers and deciding which exchange to deposit into. But I think this is a minor point. And then the observation is that conditional on the noise trader trading, let's say, Q amounts of the asset. Suppose the noise trader is trading these Q amounts, then what happens is that if the cost of the monitoring technology for the limit order book is too large,
then what happens is that these liquidity providers are passing the costs to the traders, right, to the noise traders. As a result, they will charge large bid spreads. But then what noise traders do, it will prefer to trade in the AMM. So somehow it's intuitive that basically we observe this outcome that, like, if the cost of monetary technology is large, then you leave the limit order book and you go to the AMM because you don't want to pay for the bid spreads. So I think it's a great model that highlights like this difference in terms of liquidity provision for limit order book and AMM. And it's an interesting comparison. That's like my understanding. This is, I think, the main focus of the paper. At least that's how I would frame the paper if I'm selling it. And discussion that I will make is basically in terms of the arbitrageur's action and the endogenization, I think, of the noise trader. There should be, and some, like, I will not speak too much about the endogenization of the noise trader, which I think is an important element that is like left out at the moment. But in terms of the arbitrageur's action, I basically want to make 2 points. So the idea is that after the noise trader trades, the ratio of token in the pool is altered, right? You have E0 and T0. So E0 is the amount of Ethereum token, and T0 is the amount of the other token that's exchanged against Ethereum, let's say Bitcoin. Now, what happens is that when a noise trader comes, for example, if you want to deposit more Ethereum token in order and get like the Bitcoin token, which are, let's say, the token Q, then what will happen is that we will have a different ratio between those two tokens, right? Because we have more Ethereum tokens in the pool and we have less Bitcoin tokens in the pool. So now the pool is quoting an Ethereum price which is too large somehow for the token. So what will happen is the arbitrager will come in and he will remove Ethereum token because the price is convenient. And by doing so, he will basically revert the price back to the price of the exchange rate back to what it was before, which is like what Alfred also mentioned, is this fact that arbitrager brings back the price. My understanding is that I disagree that this relation that there is an arbitrage opportunity if after trading these tokens, Ethereum tokens versus like Bitcoin tokens, then if this is larger than the original ratio, in my opinion, you have to modify a little bit this equation because you have to take into account that the arbitrager is paying the fee. So he will not really cash the full exchange rate, but he will pay a fee tau on this amount, and whatever is left goes to him. So somehow, this I think should be a straightforward modification to make. I don't think, I don't know how much it will change the results, but I think that should be the right condition. And then you can see that really Q matters, right? Because unless Q is large enough, you have an arbitrage opportunity. So only when Q is large enough, this denominator on the left-hand side is low, and therefore you will have that the ratio is large, and you will have an arbitrage opportunity. Another part that I don't agree is that the token price doesn't revert to P0, because which basically I think what we want is that the marginal benefit of trading has to break even with the marginal cost. And for this to happen, essentially we have, this will happen basically if you put the left-hand side equal to the right-hand side, and this will happen only if you multiply the left-hand side 1 minus tau by 1 over 1 minus times E0 divided by T0. So that's, I think, where the price reverts after the trade. But that's please feel free to disagree if you think that's not.
We have 2 minutes left.
Yeah. So I just want to make, analysis because pro and cons. So there is, this pros. I think we know what is the broader picture. I want to make like analysis of the cons of AMM is that there is an arbitrage loss due to front running by miners, but also there is an arbitrage loss by liquidity providers caused by the volatility of the exchange rate. In fact, I think in our paper that I noticed that Alfred is also citing in his paper, we show that even if you don't have any information asymmetry, the arbitrager basically can still, there is still an arbitrage loss faced by the liquidity provider simply because of the order execution mechanism of the blockchain. So I want to make a few comments on empirical analysis. Let me first say that, you use the dollar value liquidity pool as like a measure for the size of the liquidity pool. And I'm wondering whether, you find that the size of the liquidity pool is decreasing the token exchange rate volatility and increasing the trading volume, which is consistent with what we find in our paper. But I'm wondering whether the dollar value is a good measure because, meaning, for example, as you showed in your presentation, there are a few larger pools such as Bitcoin and Ethereum that really dominate cross-sectionally. Right? So basically you can take it with me. If you only count for those two, basically this will be enough, even if you discount all the others that you have. And I mean, another problem that I see is that there is an omitted variable bias here because you don't control for the token price. And the token price is highly correlated with the size of the pool and with dollar value of the trading volume. For example, if you look at, this is the pool size of Ethereum versus USDT. If you look now at the pool size of Ethereum versus USDC, so you see that these two are correlated. But why are those correlated? So they are correlated because they are basically very correlated to the dollar price of Ethereum. So my guess is that once you account for the dollar price of Ethereum, then you can explain already maybe 30 or 40% of the variation that you have in your regression. And this could also act as a potential confounding factor, right? Because it affects both the left-hand side of your regression, the response variable, and the explanatory variable. So that's something to think about. I want to conclude with a comment about liquidity mining. So you take a sample size that goes from November 2018 to May 2021. So during this period, there was a liquidity mining, which essentially means that Uniswap gave out token for free to liquidity providers. And with the understanding that these liquidity providers were depositing. So I'm wondering whether you should take this into account, because when you talk about liquidity evaporation, for example, we look at this period where liquidity increased and then around around September 2020, and then decreased around November. But this is also the period where basically liquidity mining stopped. So it would be interesting to see whether or not you still see this effect once you control for this additional fact that there has been liquidity mining during this period. And with this, I want to conclude. So I very much enjoyed reading the paper. I think you have interesting theoretical and empirical findings. I think going forward, you may want to do more work, especially like fixing the optional action of the arbitrager, also control for liquidity mining and token price. And yeah, that's it. That's what I wanted to share. Thank you.
Thank you very much, Agostino. Alfred, would you like to respond quickly before we go to the questions?
Sure, happy to. So thank you so much, Agostino, for this very interesting discussion and the time you put into this. So yes, you're correct that we made a slight simplification here to make the math a little bit more tractable in the paper. We did some numerical simulation, and the fee that you pay is 30 basis points in this, and the fee is proportional to the trade size, right? So the overall impact that this has on anything that you're going to find is zero. So I mean, yes, it's this quantity is slightly different that you want to trade as an arbitrager, but it's pretty negligible because the fee is so small. The math would just be really much more complicated. So we do have we are still having to pin down. So we have a few conditions in there that we have taken care of in the pictures in the paper, but that we haven't written down yet. So you're right, the minimum size of the liquidity trader has to be above a certain threshold. But again, this is really small because again, the fee is only 30 basis points and it scales in Q. So that impact is pretty small. But if you have almost no liquidity trading, yes, then an arbitrager will not bother pushing the price back. But again, this is a fairly small impact. So we compared to a lot of other papers in the microstructure literature, we do give the liquidity trader some kind of choice, and essentially this is the essential part of our model that we consider, does the liquidity trader want to trade rather with an AMM or with a limit order market. So I think in that sense, our liquidity traders are a little bit smart because they need to trade, but they compare these two market settings, and we want to find actually the setting that is better for the liquidity trader. And so that helps us identify the conditions under which these liquidity pools are preferable. So we also looked at the prices in terms of the regression in terms of ETH value. So in these markets in DeFi, it's very hard to find out what is the true numeraire. So if we should measure everything, that all the quantities that we have, volume and everything in ETH or in dollars or in euros or in whatever other currency there might be. So we did everything in ETH as well, and the results pretty much carry through that. But maybe you should put that in the paper as well. That is a good suggestion. Thank you very much for your discussion.
Alfred. I think it's perfect timing. Indeed, it's time to move to the third paper. So Oliver has a question about price discovery. Maybe you can answer him in the chat box.
Yes, I will.
And then now let's move to the third paper. It's about decentralized stablecoins and collateral risk by Ganesh.
Right, great. Thank you to Jonathan for chairing the session and for inviting me to present. So this is joint work with Roman, and both of us are at Warwick Business School. Okay, so DAI is the first decentralized stablecoin, and it is typically backed by Ethereum, and it's managed through smart contracts. So essentially, a user will deposit collateral, typically Ethereum, into a vault, and they will then be able to borrow a fraction of their collateral as DAI tokens. And the DAI token is pegged to the US dollar at 1:1. So the DAI stablecoin is managed by the Maker protocol, and Maker governance, or Maker DAO, essentially the governing organization, and they manage the stablecoin through a number of aspects. So through like setting interest rates and setting limits on borrowing and so on, which I will go through shortly. And so in this paper, we're mainly interested in what's driving the peg. So why does it sometimes trade at a premium, and why does it sometimes trade at a discount? So our study is firstly motivated by the following facts. So DAI tends to trade at a premium when Ethereum faces negative returns. DAI prices are also more volatile. So the peg itself is kind of bouncing around $1 much more when Ethereum collateral is more risky. And another thing is that the Maker DAO governing body introduced multiple collateral types in 2020. And in particular, they introduced stable collateral. And since that introduction, we find the DAI peg has become much more stable. And so the way to rationalize this is to think that risky collateral acts as a limit to arbitrage. So if you are borrowing DAI tokens from Ethereum collateral, then it's very difficult to arbitrage the DAI peg, simply because Ethereum collateral is going to fluctuate a lot. In contrast, if you are borrowing DAI tokens based on a stable collateral, then you're able to provide arbitrage to essentially take advantage of differences between the DAI price and sort of $1 peg. Okay, so in terms of related literature, we relate to three different literatures. So there's one on stablecoins, which is a growing literature, and there are many other works that I include in the paper. And essentially, they include a bunch on properties, thinking about arbitrage and safe haven properties, and as well as thinking about stability mechanisms. And so here our focus is on DAI and trying to understand both empirically and through a model the mechanisms driving premium. Okay, so the roadmap is I'll first introduce the DAI creation and governance. I'll then go through some of the key results of the model, and finally the empirical evidence. So the empirical evidence will be looking at individual CDP data, so collateralized debt position data, as well as peg prices and their correlations with Ethereum returns, and then also looking at the stable collateral types and peg efficiency. So as I mentioned, DAI works by users depositing collateral into vaults. And once you deposit collateral into a vault, you can then borrow a fraction of that collateral as DAI tokens. So that's the way you create DAI. And in the secondary market, it can be used in a number of decentralized finance applications or order book exchanges. So it can be used in Uniswap or order book exchanges or these lending protocols as well. So this idea of yield farming, so lending DAI at lucrative savings rates. So this is an example of creating DAI. So we start on the left-hand side where you've got one ether. You deposit that into collateralized debt position. You can then borrow up to two-thirds of that collateral as DAI tokens. So that's essentially a leverage limit. And in this example, the person is borrowing 66 DAI tokens from one ether collateral. And they also have the ability to redeem their DAI token. So if they want to close their CDP position, then they would simply redeem their 66 DAI tokens and then redeem their Ethereum collateral and close their vault. So a very important governance mechanism is to cap the leverage of these positions. So the leverage ratio is the DAI borrowings relative to the value of collateral. And for Ethereum, it's 2/3. So if you can borrow at any point in time 2/3 of the value of your Ethereum collateral. Now, if Ethereum prices collapse, then if the leverage goes above 2/3, then the smart contract triggers a liquidation event. And so this liquidation event essentially forces the investor to repay the debt of DAI tokens using their collateral. So what happens is that, let's say you had $100 worth of collateral, and essentially you trigger a liquidation event, and the amount of DAI you borrowed was, say, $70, then you essentially have to reduce the amount of collateral by your DAI borrowings. It's a forced liquidation. And on top of that, you have to pay a liquidation penalty of up to 15% of the DAI borrowed. So are the other stability tools that the MakerDAO governance impose are policy rates. So they also set policy rates on DAI borrowings, which is a bit like an interest rate on money implemented by a central bank. And they can also advocate for different collateral types. So through their voting system, stakeholders in the MakerDAO community can decide to adopt different collateral types. And in March 2020, they decided to have USDC, which is another stable coin, as collateral. And another significant event was in December 2020, they decided to have a mechanism where the MakerDAO governance actually has a swap of USDC for DAI at a 1-for-1 rate without users needing to deposit collateral. So this was essentially motivated as in part due to peg deviations. So these are some of the key parameters. So you can see here that the DAI price has had both significant premiums and discounts. And some of the biggest premiums that you see in the data, so the big spike in 2020 when it went to like $1.08 was the Black Thursday crypto crash when Ethereum fell by 50%. So this is essentially one of our motivating facts that DAI premiums occur when Ethereum collateral crashes. And that the leverage ratio, the red line is 66%, which is the maximum leverage. And so we know that actually the aggregate leverage is much lower than 66%. And this is mainly as a buffer. So investors know that if they're very close to the red line, then there's a big possibility of liquidation. So this is why the actual aggregate leverage is much lower than the liquidation threshold. And these are the policy rates in panel D. And you can see that they were used quite a lot in 2019. And these 2019 policy rate increases went all the way up to 20%. And this was in part due to combating discounts in 2019. Okay, so now to the model. So we have essentially a 3-period model where period 0 and period 3 are opening and closing the CDP. So the periods of interest are periods 1 and 2 when there's secondary market trading. And in period 1, we have investors that are borrowing DAI tokens and supplying DAI in the secondary market, and arbitrageurs take the long position in period 1. Now in period 2, we have a public demand shock. And in this demand shock essentially puts upward pressure on the peg price. And we then want to see the dynamics of the peg based on whether the Ethereum collateral is in a good or bad state. Okay, so the model has 3 agents. So we have speculators that are essentially depositing Ethereum collateral and borrowing DAI tokens, and they have subjective beliefs on Ethereum returns, where Ethereum returns can either go up or down. So simple 2-state process. Then speculators borrow a fraction of their collateral as DAI tokens and are selling DAI in the secondary market. And so equation 1 here is basically saying that the DAI sold by speculators is offset by arbitrageurs taking a long position. And in period 2, we also have this uninformed public demand. So think of this as a yield farming type of shock. For some reason, a lot of investors now want to use DAI to put into savings vehicles like DeFi lending protocols. And so that's this capital D in equation 2. And so now the market clearing requires that the speculator positions and the arbitrager positions have to balance out this demand. So what this will effectively do is that in a bad state, Ethereum returns are really low. So speculators do not want to deposit Ethereum collateral and borrow DAI. So essentially, speculators are very under-leveraged when Ethereum's doing badly. So this means that arbitrageurs need to step in and supply short sell DAI in order to meet the demand in period 2. And this is where having risky collateral is a limit to arbitrage. So they need to be compensated with significant premiums in period 2 in order to short sell DAI. So this is essentially where the price variation or the peg premiums are coming from. Okay, so this is essentially a numerical simulation of the result of the model. And so for comparison, we have a low volatility of Ethereum and a high volatility of Ethereum. And what I want to take away from this is that if the volatility of Ethereum is low, then speculators are not really going to deleverage in the bad state. And so you can still get peg discounts in period 2. Now, if we go to panel B, this is where we get the sort of model to line up with the empirical fact, right? So in the high volatility state, in period 2, if Ethereum is doing badly, then speculators deleverage. So now arbitrageurs have to short sell DAI to meet the demand in period 2. And they're only going to do it if they get significant premiums. And so now we get a case where we can get significant premiums in the high volatility bad state. Okay, so we can kind of generalize this effect with comparative statics. So what we are doing is essentially with the numerical simulations, we are changing the Ethereum volatility, and then we are trying to look at what happens to DAI prices, DAI volatility, and DAI leverage. And so what we find is that when volatility is higher, we are getting bigger premiums in the bad state, which is just in line with the previous slide. We are also getting a more volatile peg with more increased volatility of Ethereum. And we are also getting a reduction in leverage. So this is essentially the mechanism where an increase volatility is reducing leverage by speculators. And that's what we are seeing here numerically. We can also look at the stability rate. So the stability rate is essentially a cost of borrowing DAI. And so when that stability rate is going up, then speculators will deleverage because it's more costly to borrow DAI tokens. And when speculators deleverage, then there's less supply in the secondary market, and that's putting upward pressure on the price. So that's another prediction we can test in the data. And finally, we are looking at stable collateral as well. So here it's taking the same model, but it's adding collateral type, and the volatility of the collateral is less than the volatility of Ethereum. And so this essentially is making the point that in period 2, when the market is in a bad state, arbitrageurs can now choose a stable collateral, right? So they essentially have an ability to short sell DAI using a stable collateral. That implies extra arbitrage capital, and they can short sell at lower premiums. So essentially, this is increasing peg efficiency. Okay, and some comparative statics that the USDC volatility, if we shrink that, the share of USDC collateral goes up. So that basically means that there's a bigger arbitrage capital, and the volatility of DAI goes down as well, which is what we would expect. Okay, so now to empirical evidence. So we have data for all single collateral DAI positions. So this is every single vault that's made and all the transactions for a vault we have for the single collateral DAI. And we have at least 456 CDPs which have a sufficient time series in our data sample. And so the idea is to figure out the determinants of leverage of these CDP positions. So the outcome variable is the leverage ratio. And we can also have a dummy variable for a byte, which is when the position liquidates. So again, a liquidation event is when the leverage exceeds the leverage limit. And we want
have 2
to
minutes
see
left.
Okay. So we want to see what the determinants are. So these are just an example of a couple of CDP positions. So the one on the top was the biggest one we have in the data. And we can see that it's quite a stable leverage ratio. Whereas there's another example of a CDP that keeps liquidating. So just as a kind of contrast of a couple of positions. This is the distribution of CDP positions. So we find that, as we would expect, the majority of CDPs are well below the leverage limit of 66%. And the results, we find that essentially the volatility of Ethereum, when volatility of Ethereum is high, we have a reduction in leverage and we have an increase in the probability of a liquidation event. And the stability fee also plays a role. So when the cost of borrowing DAI increases, we also get a reduction in leverage. So using similar explanatory variables, we can look at correlations with the DAI price. So just kind of a brief summary, we find that as in line with the model, when DAI price is traded at a premium, Ethereum returns are negative. So there's this negative correlation. And we also find a positive correlation between Ethereum volatility and DAI volatility. We then look at the effect of liquidations, and March 12, 2020 was the Black Thursday event. And we see big DAI premiums and big DAI liquidations when Ethereum collapsed. And we find that liquidations are associated with DAI premiums. So a 10 million liquidation results in about a 300 basis point premium according to our regression result. Okay, and the final thing is the case study. So we find that following the peg stability module in December 2020, the DAI peg is much more stable. And we can see on the right-hand side that while Ethereum was still the main collateral as of March 2021, USDC essentially became much more prominent type of collateral. And we just do some basic sort of analysis of the effects of USDC collateral. And what I want to conclude with is that as the share of USDC collateral goes up, the DAI prices get smaller, right? So that's in line with the model where increased USDC collateral is kind of lowering the premiums because arbitrageurs have more arbitrage capital. So I will finish there. So we found evidence that collateral risk matters for the peg. We explained through a model correlation between the collateral and DAI premiums and discounts. And there are a number of open questions like how should Facebook Libra be designed? Is it possible to extend the peg stability module to having a digital dollar, for example? And so there's many open questions still in this line of research. Thank you.
Thank you. So Oliver, the floor is yours.
Thanks, Jonathan, and thanks to the organizers for inviting me to discuss the paper. It was great pleasure reading the paper, and yeah, so it's quite extensive, I would say. So I focus on the results which I found most interesting. So I very much recommend reading to all of you the paper. First of all, I work at the SMB, so of course the usual disclaimer applies. Maybe to give full credit to the paper and praise to what they do and to give the big picture, right? So crypto assets are extremely popular, right? So they have a big problem. They are too volatile. So the question is, okay, we want to introduce stablecoin as a crypto asset that aims to have this stability as a price to this specific asset. And usually this is a fiat currency, so the US dollar. And then the question is, how do you create this stability? And there's a few options, and this chart is one of out of the paper with Thomas Moser, which we have. So one option is you have an on-chain asset backed, and this is the DAI. And so this is what Ganesh and Roman look at. They study the DAI as a case study, how to create the stability in a crypto asset vis-a-vis the US dollar. And they do a useful policy analysis, so how to create a relatively stable coin in terms of the policy instruments. He mentioned the interest rates, collateral as well. So the question is like, how does this perform? And they focus on this aspect of on-chain asset backed. So what they do is they formulate a fairly general model of limit arbitrage, if you want so, with speculators. They are investors in ETH, and they want to leverage these ETH positions by borrowing DAI. So they deposit it in the vault, they get some part of it as DAI back and can invest again in ETH. And depending on their expectations, whether they have a good or bad outlook on ETH returns. Then you have arbitrageurs, which buy DAI if DAI trades at a discount, or short sell the DAI when DAI trades at a premium. So to go back basically to the parity. And then finally, you have investors who create these exogenous demand for DAI based on their applicants or because they use it for DeFi applications or whatnot. And then they do comparative statics exercise by calibrating this general model to the DAI and find some kind of intuitive results which fit the stylized effects, also which you've seen in the pictures from Ganesh's presentation. And then they get a very rich data set, and I think it's the first data set using these collateralized debt positions as well as prices, and then can confirm stylized effects from their model on DAI with their empirical analysis. And what I see as their key results and contributions is first that the DAI price correlates negatively with the ETH collateral returns. So basically, collateral risk is priced directly in the price of DAI vis-a-vis the reference asset in the pack. And secondly, the stable collateral I increases the pack stability because it gives arbitrageurs a way to borrow DAI and with less capital cost, if you want so, because they need less margins for the stable collateral to sell the DAI. And thereby they have a new and relevant contribution to the literature, first on stablecoins as well as to the limits to arbitrage literature. So turning to the discussion, I think first on the model, I found it very interesting because it's a relatively simple model, if you want so. You have the three different types of agents, but all of them are kind of like very sterilized or stylized, if you want so. So this negative correlation which you have with the collateral, I think is very much driven by the good bad outcome behavior of the speculators. So I was wondering whether when you allow speculators to form, for example, mean reverting expectations, how does this change the results of the model prediction? So I think the literature of speculative behavior knows like various different types of speculation. Only one is this extrapolation, and this is basically our exploitative expectations, and this is basically what is captured in the model, right? So you directly have this view on ETH. And then from a policymaker perspective, I was wondering whether there's some scope or some interest, some stake of someone to limit this leverage, because basically in traditional financial markets, we know that this can be harmful, and the FSB and then further national authorities have formed some view on limiting excessive leverage in the shadow banking system, right? And so you have the respective regulation from the FSP on securities financing transactions, repo, which is exactly this, I guess. And so the question from my perspective was, is there some case that also regulators want to have a saying there from that perspective? Or maybe it's even in the interest of maker, because they are interested in this stability of DAI price. So maybe they also have an interest on saying on what can be leveraged and be strict on that. The second group is the arbitrageurs, and the result, I think, in terms of this limits of arbitrage is very much driven by the short selling capacity of arbitrageurs. Only if they want to sell the DAI, then they need to borrow, and then they need to post collateral. And if it's a risky collateral, they put a high margin on it, not to be liquidated. If it's a risky collateral, they put a high margin on it. So what happens if DAI is at a discount? They can just buy DAI without having to put any margin. So my question was, is the limits of arbitrage really completely symmetric for the arbitrageurs? Or is it only if DAI is at a premium, and if DAI is at a discount, they don't need this stable collateral? You mentioned it before. In 2019, they had use of the policy rates. So question is, why didn't they at that time already include the stable collateral? Maybe there was not need because DAI was rather at a discount than at a premium. Yeah. So and then the question is, if the arbitrageurs play such a big role, so why not really institutionalize the role for these arbitrageurs by maybe having some primary dealers, giving some benefits or for this activity. And then secondly, and I think you mentioned this earlier when you sent me your presentation, the investors you assume to be completely exogenous. But my question is, are they really completely exogenous? And this is the left-hand side picture where you see that the demand, or so this the use of DAI in different forms of financing, and then you see that really this has increased, first of all, and secondly, it changes over time and has some fluctuations. And this is certainly correlated with risk, some risk environment, if you want so. So I think it's not quite fair to assume it's completely exogenous, and I think there is data available on this, so I think it would make sense to include this also in the model.
We have
Secondly,
2 more minutes.
Thanks. So the second point I wanted to mention is on the collateral, and I think is very kind of like confirms the literature which has been already done for other securities financing markets. Here I show a chart from Nieborg and Rösler working paper on the EONIA general collateral spread. So for the euro money market, if you want so, and you see that usually the unsecured rate is above the secured financing rate, but sometimes you see that the secured is below the unsecured, which is kind of weird, right? Counterintuitive. And then the authors point this down to limits of arbitrage, and I think it's completely the same literature and same channels, if you want so, as in this paper. And then I found it interesting because this collateral channel we don't find in our paper with Thomas Moser, where we look at different stable coins and their safe haven properties. And we don't find that the collateral compared to different forms of stability, kind of fiat collateral or of commodity collateral, is not a determinant of the safe haven properties. So going kind of like counterintuitively. And I think this gives a very nice link, and I want to wrap up my discussion here, because to go again one step back. So the question was, so how to make the stable coin stable? And the first problem is that stability is defined as a price against a fiat currency, against the US dollar. And so as long as you do not pay your consumer price index in DAI, you will always have this link to a fiat currency. So the key question is like how to create this stability against the fiat currency. And so now here they use this introduction of the USDC swap. But then my question is this really like a good way to do it? Because now you have a stable coin, you go on the on-chain asset-backed link, if you want so, to create the stability, which is completely on-chain, right? So you are staying in this decentralized world, but then you link it to a stablecoin, which is an off-chain asset-backed stablecoin, and you really create again the link to the fiat currency. So my question would be, why not directly linking it to the US dollar can circle the issuer of USDC, do it better, doing the transfer from US dollar to USDC to DAI. So maybe Maker can also provide a link between and tokenize US dollar in a way so it creates the stability. I'm not quite sure whether this is really optimal, especially because of the background of USDC being now in the media, of having late attestations of how they invest their money, and also about the question, how much does really Maker get out of this USDC investment which they have. At the left-hand side, you see the asset composition of Maker, the issuer of DAI, and you see that the part of stablecoins and turquoise has increased quite substantially and is now above 50%. And stablecoins is basically USDC. I think it's 96% of all stablecoin holdings of Maker. And so my question is, why linking it to USDC and not then just moving to the off-chain asset-backed stablecoins? Thanks.
Thank you. Ganesh, would you like to have some quick responses before we go to questions?
Yes, thank you very much to Oliver. That was very good discussion. So there were a lot of points. So I think the first point was about the mean reverting expectations. So I do agree that the subjective beliefs of the good and bad state are very important to get the result that DAI premiums occur in bad states. And arbitrageurs do not share that same expectation. So that kind of generates a different, so they're kind of more unbiased when it comes to whether Ethereum's going up or down. But yeah, my feeling is that, yeah, we do require this assumption, but we can try to see as well, like what happens when we relax this. The limit on leverage, so we don't go into changing the limit on leverage, but I do agree that if you were to change the limits, that would be one way to be essentially try to reduce the possibility of liquidation events. So right now it's 2/3 of collateral for Ethereum, but if they were to drop it to, like, say 1/3 of collateral is the maximum amount of DAI borrowing, that would probably reduce the rate of liquidations, but that's outside our model. And yeah, I absolutely agree. The arbitrage limits to arbitrage are asymmetric. So we emphasize more about the short selling of DAI when DAI trades at a premium. But I agree that our model implies that premiums are essentially more destabilizing than discounts. And I think, I haven't confirmed it, but the half-life of deviations are longer for premiums. So there is this idea that premiums are a bit more persistent than discounts. And yeah, the other things on demand, so we are trying to get proxies for demand through, like, sort of demand for DAI and like DeFi lending protocols. And I also will look at the Nyborg and Rosler paper kind of as a sort of comparison to more mainstream literature. And yeah, the last point, I guess, was on the USDC collateral type. So I do agree that if we were to tokenize a digital dollar, that could be, I guess, a dominant choice because there's no custodial risk. So I guess that there's still this issue that USDC could collapse and then MakerDAO is kind of essentially taking losses because they're swapping essentially a worthless coin for DAI. So there's still kind of a custodial risk issue by effectively pegging to USDC. But in principle, a digital dollar that's tokenized would be, I guess, a dominant safe collateral type. And yeah, the other thing was the safe haven effect. So I guess we can kind of touch base after this, but I was thinking that, yeah, it's very specific type of safe haven effect that we are trying to get for DAI, and that's mainly based on this relationship with Ethereum collateral, but it could be for other collateral-backed stable coins that maybe that same sort of correlations don't apply. So I guess by no means we're trying to make a general statement on safe haven properties here. But yeah, that's all.
Okay.
Thanks.
So thank you. Before we go to the Q&A, let me, since it's now 2:45, let me first thank the speakers for a fantastic session, and thanks everyone for questions and discussion. But if you have time, please stay and continue the discussion. Otherwise, see you and enjoy the rest of the conference. Ganesh, indeed, I want to ask, so it seems like this predetermined liquidation threshold could lead to some kind of fire sale externality, no? So that once you hit the threshold, say the collateral like ETH will be liquidated, that drive down the collateral price further and generate kind of a downward spiral, but also can lead to contagion to other protocol that collateralize on ETH or other collateral. Did you or other people have kind of quantified this type of effect?
Yeah, so we take the Ethereum price as exogenous, but I agree that if the DAI market cap is sufficiently high, then you could get this liquidation spiral where the sort of collapse in Ethereum prices triggers a liquidation, which triggers fire sales of Ethereum collateral, which causes further declines in Ethereum prices, increased liquidations, and then you get this liquidation spiral. But I think that right now DAI is not sufficiently big enough to cause that spiral. But I do agree that in theory, if it reaches that scale, then that could well happen.
Another question is about kind of congestion, and that's maybe also related to Alfred's paper. So my understanding is that what happened in March 2020, right, was very much related to network congestion and Oracle problem that lead to, you know, the auction price drop to zero, and I also that in the Uniswap case, my understanding is that well, in May 2021, right, we observed a crash, and then the performance of the centralized and decentralized exchanges are quite different, right? For those centralized exchange, we observed outages, right? They couldn't handle so many transactions, while for decentralized exchanges, they were functioning smoothly, but the gas price increased substantially. So I was wondering, so in the case of Uniswap, we didn't observe too much withdrawal. Is it related to a kind of the high gas price that make it not worthwhile for the LP to withdraw?
Yeah, Jonathan, I think that's why I asked something like, okay, what preventing the liquidity provider from leaving? So they seem very stable, right? So it related to Ganesh, maybe the paper, and also Alfred is so in essentially so when a liquidity provider see a big order outflow, so in the liquidity pool, so they can flip the market, right? So in this case, I withdraw the liquidity and then trading in the same direction at the arbitrage, and then push up the price of the remaining liquidity pool. So, and this happened for some stablecoin recently called Iron. I don't know whether you have heard about it. So Maarten invests a lot on this, and it got killed exactly by the same mechanism. So it is a stablecoin using the algorithm rather than using the collateral, exactly because there is a bank run on the liquidity pool. So the whale, so the big investor try to flip the position from the liquidity provider to become an arbitrager. and the stablecoin collapse. I'm just wondering what prevent them from flipping their position in maybe related to Ganesh and also Alfred paper. So what makes it stable?
So
But
if I think that first of all we looked for these sudden withdrawals of liquidity, and I think this is not happening. There is front running happening on Uniswap, and we see that people front run other trades, but that's not necessarily bad for the liquidity providers. They just collect more fees, right? So for them, if you move along this curve back and forth because somebody front runs somebody else, that's not really that big of a concern for the liquidity providers. If the liquidity providers try to front run big trades by withdrawing liquidity or ejecting additional liquidity, we don't see that on the chain. So we don't see these high frequency movements in liquidity provision. I think to answer part of your question, what happened in this big Ethereum crash and the decentralized markets, I think that, yes, on the one hand, higher gas fees might prevent people from withdrawing the liquidity out of these pools. On the other hand, if you see a lot of trading, that's great for you as a liquidity provider because you collect a lot of fees. So in that sense, I think there's these two offsetting forces. Overall, we didn't see that that much in liquidity withdrawal over this period of time. There was only after the prices have come down a lot, after everything has come down. And I would argue that's more consistent with the idea that there's less expectation of future trading.
Can I ask a question about the setup? Say, originally, say two tokens, A and B, when you deposit, it's say 1-for-1. And then after some time, when you trade, maybe after it becomes 2-to-1. So when you withdraw, do you get it proportionally 2-to-1 or the original proportion 1-to-1?
New proportions. The 2-to-1.
2-to-1. New proportion. So that's why it will not affect the price when you withdraw the liquidity because it's just moving down the indifference curve.
Just just moving the indifference curve and
right.
Making it higher price impact. But it's like a mutual fund. Whatever you just inject something in the mutual fund, and then whenever you decide to withdraw from the fund, you get a share of whatever is in the fund at that point in time.
Right, so it will only shifting the price when you withdraw and also trading in the same direction at the arbitrage. So that you can have some effect price impact. So
So you would need to combine a withdrawal with a trade. So the trades shift the price, but additions or withdrawals don't shift the price in the liquidity pool.
Okay, are there other questions for the three papers? Okay, then given the time, I guess maybe we should wrap up. Thank you again for everyone for attending and presenting very nice papers and all the questions and discussions. See you and enjoy the rest of the conference.
Great. Thank you, Jonathan. Thank you,
Thank
everyone.
you, Jonathan.
Thank you very much.
So Maarten, I am wondering how you make the slide at your backdrop. I can do it side by side, but not front and behind. That's super